How's it going? My name is Jonathan Zaragoza, and this is my presentation on private placement offers and due diligence. On this first slide, we're going to cover what private placement offerings are and how they differ from the more common forms of raising capital. As we know, one of the most traditional forms of raising capital is through initial public offerings. Alternative to IPOs, private placement allows firms to raise capital through private funding, of which these opportunities are only available to few select investors. These select investors, we include accredited investors, which are people who make over $200,000 a year or have a combined net worth of over $1 million. Most major banks are included in the investment opportunity, mutual funds, insurance firms, and pension funds as well. And as we know, this is a private offering, so the securities are not available to be purchased on the open market. In comparison to publicly traded securities, there is minimal regulation with PPOs. They are not subject to the same disclosure and reporting requirements as with publicly traded securities. And though the securities are sold, the Section 5 registry under the Securities Act of 1933 is not required, thus saving the company time and money in comparison to other forms of raising invested capital. So it not only saves them money, but it saves them time, and they're able to allocate or able to raise the same amount of funds in a quicker process. Moving on, we're going to talk a bit about what a term sheet is. The term sheet is basically a non-binding document or agreement that outlines the basic terms and conditions under which an investment will be made. Included in the term sheet is typically the involved party, so who is going to be involved, the exchange term, so who is giving up for what in exchange for what. Typically that includes how much equity somebody's going to get in exchange for how much invested capital they're giving. And it also includes the price per share, as well as voting rights and the structure of the board of directors. Most importantly, I believe most investors care about the voting rights and whether or not they're going to have any type of voting right of whether or which way the company is going. And not only this, the term sheet allows for the involved parties to discuss the differences between a formal and like I said, it more importantly allows for the involved party to discuss the differences between the two parties or more parties before the legal binding contract is actually formed. So it leaves room for negotiation before a formal document is signed and the actual agreement that can be legally binding is approved and signed for. Onto our last slide, we have our due diligence slide. Basically, due diligence is an investor's process of reviewing all of the information they have available to them regarding that business venture. That can include reviewing the financial statements to make sure that the company's earnings have been accurate over the last couple of years according to what they're giving us. It includes the evaluation of the company, so what the company is worth at the time and what they projected it to be worth a few years down the line. Included into that valuation is projections as well, like I said, what their earnings before taxes will be in the future, whether it's 5 years down the line, 10 years down the line. It gives investors a picture of what the company can be worth over the time, and basically just gives investors the room to review that they weren't over exaggerating certain earnings over the future projections, and more importantly gives the investor time to review that the contracts that are stated within the company's operations are legitimate and that they are still in contract with other businesses that they sell products to or services to. That concludes my presentation on private placement offerings, private placement memorandum, and due diligence. I hope you guys enjoy it.